Well, hello everyone, and welcome to our second seminar in this series here, developed to increase your knowledge of carbon markets in Australia and also connect you to the latest developments and happenings in the international marketplace. So last week we kicked things off with a deep dive on international markets, where we heard about the growing level of activity in voluntary markets, both from the corporate sector, with an increasing number of organisations setting ambitious long-term emission reduction targets and carbon neutral goals, but also at the regional and subnational level, with a look at pilot initiatives and market linkages occurring around the world in advance of the Article 6 Paris Agreement being finalised. And today we're going to bring the discussion closer to home with a look here at the domestic market in Australia. So we're joined by Cameron Matthew today from the Clean Energy Regulator and Raf Wood from Market Advisory Group for an update on carbon market developments and their insights on the future of carbon markets, including supply and demand dynamics, price expectations, and other key information to support you and your organisation. So whether you're just starting out to explore the world of carbon markets or already engaged and looking to further develop your long-term climate strategy and opportunities, I'm sure there'll be plenty of takeaways for you in today's seminar. So before we get started, a reminder that we're continuing with this seminar series over the coming weeks and months, and you'll see on the slide here that our schedule of virtual events is covering a wide range of topics. I know many of you have signed up for the entire series, and we look forward to having you along to all the sessions. So as I mentioned, to start proceedings today, I'd like to welcome Cameron Matthew, Manager of Economic Analysis at the CER, for a comprehensive update on the domestic market. We'll then be joined by Raf Wood before moving to a live Q&A, but no need to wait until then for your questions, of course. Please use the Q&A box to send them through at any stage throughout today's session. And we do want to interact with you as much as possible. You can even let us know which questions you like and really want us to answer by using the upvote feature for questions already asked. So with that in mind, let's head over to Canberra, where Cameron is waiting to give us an update on the domestic market. Thanks, Cameron, and welcome.
Thanks, Gloria. Appreciate the introduction. Thanks, everyone, for coming along. I don't know how comprehensive I'm going to be in the time, Gloria, but we'll see how we go. I'll just pop my presentation up for everyone and we'll see how we go. Okay. So, my presentation today is focused on the supply and demand dynamics in the domestic Australian carbon market, with a bit of backcasting to last week because the international units do play a role domestically, and we'll see how that works as we roll through. I mean, getting involved in carbon markets, has many elements to it. There's regulatory and compliance elements, government purchasing, and of course corporate climate goals, and the voluntary sector and how they all interact. So it's quite dynamic in the way it works. And you need to understand, get a good picture of all of these elements before you just jump in. That's what the seminar series is really trying to do. So I'll be focusing on the domestic, particularly examining both the effects of Australian Carbon Credit Units, ACCUs, under the Emissions Reduction Fund and Climate Solutions Fund, and large-scale generation certificates under the Large-Scale Renewable Energy Target, and exploring how they interact, what's going on in both sectors, and then I'll touch a little bit on the future of carbon markets, thinking a little bit about some of the policy announcements that have come out, and kind of where they might point towards the future. Before we get too far into it, just so everyone remembers who the Clean Energy Regulator is, Clean Energy Regulator has been around for 8 years now, and we essentially regulate the national level domestic carbon units in Australia. So we administer the Emissions Reduction Fund and Climate Solutions Fund, the Greenhouse and Energy Reporting Scheme, and the Renewable Energy Target. And we also administer the two registries, the ANRU, the Australian National Registry of Emissions Units, and the REC Registry, the ANRU being used for ACCUs and international units in Australia, and the REC Registry being used for large-scale and small-scale certificates. Just one thing to note about all of this, our schemes are actually quite mature now, and these carbon markets have been around for quite a while. Our ACCUs have been around for 8 years now, and the registry longer still. And our renewable energy target and our renewable energy certificates have been around for 20 years now. So there is a well-established government framework for the trading and operation of carbon units in the country. Looking at what carbon markets do, I think it's important to have reference to this. Carbon markets and the schemes that underpin them are one of the main ways Australia is driving emissions reduction in this country. Carbon units represent or are going to exceed 50 megatons worth of equivalent abatement. So, you know, the amount of abatement embodied in all of those certificates. And that represents nearly 10% of Australia's emissions. So carbon markets are one of the main ways that emissions reduction is being driven in Australia. And a really important thing to consider as well is that the abatement comes predominantly from regions in Australia, regional Australia. 76% in fact is in regions, about 24 in urban areas. So it does have a very strong regional bent. It is really important for regional economic growth and development. The two main carbon abatement regions, Outback Queensland and Far West Orana, are quite phenomenal in the amount of carbon abatement across large scale, small scale and emissions reduction projects under the ERF. So it's important to note how valuable carbon units are and the fact that it's going to continue to grow as a sector for reducing emissions going forwards. So in thinking about how the CER interacts with climate goals and your climate goals, you can operate on both sides of our schemes and both sides of our markets. There are opportunities to run your own emissions reduction fund project. So if it's energy efficiency, you can install rooftop solar, and you can even install large-scale solar if you're set up in a large facility. So you can actually participate on the supply side and see the incentives that come to those projects come your way by undertaking projects and installing renewables. On the other side, you can also use the offset units that come about, or the renewable units that come about, to purchase them to demonstrate your long-term emissions reduction goals. You can purchase them through long-term contracts, like things like power purchase agreements that might come with large-scale generation certificates, or long-term supply contracts for ACCUs. And you can participate on the spot market, buying and selling, interacting with brokers, interacting with other buyers and sellers who are willing to trade. And then, of course, you need to interact with our registries themselves. Quite often, most market participants have a REC registry and an ANREW account, and they use them to hold, sell and surrender those units. The important thing there is surrender, because ultimately you can't demonstrate that you've achieved your goal using carbon certificates until you've surrendered them or taken them out of circulation. That's just a bit of a high level. Obviously, Gloria introduced the Markets 101 that CMI and the Clean Energy Regulator did earlier this year. That's a really good basis to go and understand the ins and outs of these schemes. But I'm going to jump now into the data, because that's always the exciting bit. So let's go and check it out. Let's have a look at the size of Australia's carbon market first. Australia's carbon market is made up of lots of component parts. There are, as I said, regulatory or compliance markets, there is government purchasing, and there's voluntary and state and territory activity. The states and territories also have their own schemes in some respects. The Victorian Energy Efficiency Certificates and New South Wales Savings Certificates are also forms of carbon unit or energy efficiency certificates, which again might be able to be used to help further your emissions reduction activities. But looking at the national level schemes, which is kind of where the CER fits, I've mapped out here where the ACCUs, large-scale generation certificates and voluntary sectors fit. And this is current to about the start of 2019. We're doing another one of these now, and we'll release it soon to give you a picture of the 2020 version. But the real upshot here is that 12% of Australia's carbon market is actually made up of voluntary or non-government participation, non-Commonwealth government participation. 10% of this, just to give you a bit of an idea, the voluntary market in this chart's worth about 3 million tonnes of abatement each year, the bulk of which, 10 out of 12 certificates, come from the international sector. So they will come from the Clean Development Mechanisms certified emissions reductions, verified carbon units, and verified emissions reduction units from the Gold Standard and Verra schemes. So that's 10% of the market, and obviously we explored last week, international certificates do trade a little bit cheaper than domestic units, and that's one of the reasons that so far Australian companies have gone towards international units. But that's not to say that there's not a fair bit of activity using domestic units by Australian corporations. So 1 in 12 is an LGC and 1 in 12 is an ACCU. And we're seeing quite a lot of growth. Just to put that into perspective a bit more, this is kind of current as at a couple of days ago. What's going on in the voluntary carbon markets in terms of the surrenders going on. And in fact, we've had a phenomenal Q2 in terms of both ACCU and LGC surrender. And you can see there that there is substantial growth in both the regularity and the volume of ACCUs and LGCs surrendered to meet corporate climate goals. If you're wondering what the big spikes are, the big spikes are actually green power, and green power is again another way in which corporations can essentially ensure that they're buying renewable electricity, and we'll see that again this year, another big spike. But the general picture is up and up quite strongly. We're looking at doubling at the moment, the kind of 2019-20 financial year versus the previous. So it's quite substantial growth, and it's clear to see that Australian companies are actually getting very heavily involved in buying and surrendering carbon units. Just to put it into perspective, there's about 650,000 ACCUs this year, and probably about 1.5 million LGCs, and that's going to continue to increase. So it's really encouraging to see that trend take off. Looking at prices now, just to give you a feel of a comparison between the two certificates and understanding what's going on. LGCs are still a more expensive carbon unit, and we'll go a little bit into the future and how that might change soon. But there is a substantial number of LGCs that entities are generating themselves and surrendering as well. On the ACCU, and so prices are sitting at about $40 at the moment. They've crept up a little bit in the last little while, after a bit of a bottoming out in the $30 range earlier this year. ACCUs have come back a little bit, kind of from highs of the mid-17s down to about $15.80, $16 at the moment. And in fact, the gap between the contract price and the ACCU price has actually slimmed quite a lot lately. So there's actually no real difference between the long-term government contract price from our last auction and the spot price. I might throw to Raf maybe to explore that point. He might have a view on that when he presents next. But talking about the auction, so in the ACCU market, let's focus on the ACCU market for a little while. The main driver of abatement to date has been Commonwealth auctions and Commonwealth procurement, so Australian government procurement. The last auction saw 1.7 million tonnes of abatement purchased across 11 projects. So we saw an uptick. Auction 9 was very low volume, and in fact we saw that come back in auction 10 at an average price of $16.14. One of the interesting dynamics though about this auction 10 is it was the first time that the Clean Energy Regulator offered optional delivery contracts. And so the optional delivery contracts, and in fact 2/3 of contracts actually went to optional delivery contracts. Those contracts allow the seller of the units, the buyer being the CER, the Australian government, to choose whether or not to deliver them, or have the alternative to deliver them to someone else in the marketplace. So it's really exciting from a perspective of what might be available to other market participants, so those corporations looking to source ACCUs, because it essentially allows those to deliver to either market, and that means that, you know, an earlier concern that the market had, that the Australian government was locking up all of the supply, gets eased quite a lot through this option. So it's very exciting, and it's very exciting to see entities take that up. We've been consulting a little bit on the design of this to make the optional contract work a little bit better, and we've received feedback and we're processing that now. And it will be something that plays a role in auction 11. Auction 11 is happening on the 9th and 10th of September this year. So if you're looking to sell additional units, or you have a project that you want to secure a contract for, that auction is coming up quite soon. But thinking a little bit more about the units available, I think it's important to have a look at the current supply and demand balance in the ACCU market. This is to Q1. This isn't to Q2 yet, so that'll come out in our quarterly market report soon. But we've got quite a substantial balance of units in accounts at the moment, and a portion of that, and we're doing some analysis to hopefully release soon around the breakdown of that, potentially. A fair bit of that is available for secondary market participants, and we have seen that balance grow quite substantially. So something to consider is that with a nice balance like that, there is units available. We've seen supply generally grow year on year from about 14.5 to about 6 last year, to about what we're expecting is about 16 or more this year. So there is quite substantial growth in the supply of ACCUs, and that's looking to continue. So in particular, as I said, that last auction did stimulate a bit of activity, and that's really showing up in the registration of projects at the moment. So in the ACCU market, we're seeing over the first 2 quarters of this year, we've actually had more projects registered than in all of 2019. So it's quite a solid start to the year, and that's probably in part projects responding to the new optional delivery contract that might change the risk profile for them, and also maybe responding to the prices in the spot and the contracts markets. An interesting other aspect of that is definitely we're seeing a lot more diversity. You can see there that for the first time, particularly in Q2, vegetation-based projects make up less than half of registered projects. Now, typically the ERF's Climate Solutions Fund has been dominated by vegetation projects, and now we're seeing it opening up. There's been quite a lot of waste projects registered recently, a number of energy efficiency projects, and even some additional savanna burning ones. So the diversity is growing, which is fantastic to see, because that supports a very strong supply side and provides a bit of reliability that ACCUs are there to buy. Now, the other dynamic that I just wanted to explore, because this is important to those with kind of carbon goals, is the co-benefits story. And this chart shows nicely that there is a clear preference in the voluntary markets rather than the compliance and the government procurement markets for specific types of units, primarily savanna burning units. And in Q2, so this is updated to Q2, we've seen quite a substantial number of savanna burning credits. Close to 75% of all units that were consumed by the voluntary sector came from savanna burning projects, and that obviously reflects a commitment by a lot of businesses to support Indigenous communities that are tightly linked to those savanna burning projects. There is a bit of vegetation, and interestingly enough, waste sector credits have been used a little bit in voluntary credits for the first time over the last three quarters. We didn't see any real volume there until previously Q2 of 2018. So a few little dynamics there to consider. The last one on the ACCU market I wanted to share was the secondary market and what's kind of going on in terms of trades and frequency of trades. We showed this slide last year, and it's encouraging to see that the volume of trades is actually kind of at a kind of a new plateau from previously, typically about 20 trades a month. Volumes are in the kind of 200 to 500,000 ACCUs a month. And so that's encouraging to see a reasonable volume of trades, which facilitates a kind of more liquid market and a bit more price discovery. An interesting note, so if you were participating last year in these workshops, it was very exciting to see quite a lot of trading going on the sidelines of these workshops. So I encourage you, as the presenters come forward, to make contact with them and work with them if you want to trade, buy, sell ACCUs, or LGCs for that matter. Was that we had a nice little spike in the volume of ACCUs transacted straight after the last year's workshop. So I'm expecting a nice little spike in July and August after these workshops stimulate that activity and stimulate everyone's interest in carbon markets. So let's look forward to that. Turning now a little bit to renewables. So, as I said, LGCs are equally used by Australian companies to meet their corporate carbon goals. And one of the interesting things about the large-scale generation certificates is, to date, the vast bulk of these LGCs have been consumed under the renewable energy target. We're getting very close to the end of 2020, and we've already made it very clear that we'll surpass that target in terms of, in particular, the capacity needed. And we said in about 2016 that we needed another 6.4 gigawatts of large-scale renewables to be brought on. We're now double that at 12 gigawatts, and that's what this shows here. This is the renewable energy pipeline, which just keeps going up and up, which is really exciting to see. But that has real implications for the carbon market, and something everyone needs to kind of understand and think carefully about, because what that means is that we're going to have enough units to meet the target, and every time a large-scale power station is built over and above that, they are additional LGCs that may be used by the voluntary market to help meet climate goals. And looking more carefully, you can kind of see the growth here quarter by quarter in LGCs. It's quite solid, and in fact, some of the recent projects that have just come off are going to drive more and more LGC supply. So it is really encouraging, and in fact that shows through in price. So we showed price before up to the current period, but if we look a bit further, if we look out 3-4 years, and the great thing about the LGC market is that there are various prices agreed in future years, and it gives us a forward cost curve to think about the future. What I've done here in this chart is, in fact, modulated the LGC price by its carbon value. So I've tried to make LGCs and ACCUs kind of equivalent in the value of their carbon abatement, so to speak. And what you can see here is that there is a bit of a convergence going on. I think we talked a little bit about this last year, and you've seen this in some of our reports, but it's very clear the convergence is still happening, and you can see that through kind of more people being interested in surrendering LGCs. That convergence happens in 2023 at the moment on the back of where those forwards suggest we will be. And kind of really interestingly, and this has only come through in the last week or so, forward trades, the first forward trade I've seen anyway for LGCs for 2024 is about $5.50. And it'll take a bit of time for that forward price to firm up, and I wouldn't bank on that. But, you know, if that trajectory continues, those LGCs are competitive with some international voluntary carbon units. And certainly depending on the outlook, your outlook for a future CDM, LGCs look quite competitive to be used in volume. So that's something to look out for. That's not to mean that we're going to see a decrease in ACCUs, and as I said, those co-benefits and the story that comes with ACCUs, as well as the fact that ACCUs are the ones that you use to offset your direct emissions, means that there's going to be a market for both of them in the voluntary sector, and they're going to be used in large volumes, we think. Finishing off, just to flag a little bit about what's going on in the future. Let's all guess. So there's a number of large policy documents underway or finished in the recent couple of months. The first of those that has a lot of impact, particularly on the ACCU market, is the report of the expert panel, the King Review, as most people call it. It's going to signal some future directions in carbon markets. It includes a number of recommendations, about 26 recommendations, and the government has responded to that and accepted the bulk of those. That includes recommendations for a below baseline crediting mechanism for safeguard entities to maybe drive further activity for large facilities to reduce their emissions, and a series of recommendations around ways to unlock supply and support voluntary demand. So I highly recommend you checking out that review and the report if you haven't yet. the next steps now is for government to consider those recommendations and for people to start pulling together options papers and putting that out to people to see how we might design these things. So please get involved in those. The other two that are worth thinking a lot about, the technology and bioenergy roadmap, which are kind of in progress, provide some really important new linkages with carbon markets. And in fact, I think carbon markets will feature quite strongly in terms of using, reducing the cost of certain carbon abatement, and that'll come through in the technology roadmap, and maybe thinking about some of the bioenergy stuff that does exist in the ACCU and the LGC markets at the moment, and how that goes between now and 2030 in the future. So again, please take note of those, because they are kind of central documents to how the carbon market might evolve in the future. If you have any questions, you can email us or and get in contact. My economic analysis team, you can reach us at markets@cleanenergyregulator.gov.au. Very happy to talk about anything that you might want to talk about. Very interested in what extra data you might be wanting to see. And no one gets out of this presentation without a shameless plug. So I'm going to plug the quarterly carbon markets report. This pulls together a lot of the data that you've seen today, but it also tries to give a kind of view about some of the features and the future of carbon markets, and try to provide some insights that you may not have thought about before. So please check that out. Not surprisingly, it comes out every quarter, and if you're not subscribed to it, you can go to the CER and get on our subscriptions list. So please do if you want to. Other than that, I'll wait for some questions, and thank you very much for listening.
Thanks, Cam. That was great, very interesting. I will post that link for the quarterly carbon market report in the chat very shortly. Interesting to see also the diversity of project types coming on in the voluntary surrenders around savanna burning and waste, in addition to vegetation, which is quite interesting to see. Also, as you mentioned, the next ERF auction 9th and 10th of September, so keep that in mind for everyone. Now I'd like to pass on to Raphael Wood, who's the Managing Director at the Market Advisory Group. Raf's also coming to us from Canberra today, and he's going to share with us now some of his outlook and perspectives from an experienced player in the game. Over to you, Raf. We might just ask you to unmute yourself, Raf.
Yeah. I think we duelled there. Yeah, thanks very much for having us today. Raphael Wood, as Gloria said, the Managing Director of Market Advisory Group. I worked for 5 years at the Clean Energy Regulator, I think in Cam's job, before leaving in 2015, where we designed and implemented the market for the government there. So, we've been around since its birth. Market Advisory Group provides independent consulting to the industry, the demand side, the supply side, and government. We provide a range of services from analytics to supply and demand dynamics, is what we'll be talking about today, around the market dynamics, forward price estimates, to help then take those forward price curves and implement a strategy based on analytics, more than just ambition, and then to help our clients through the procurement process, and managing transactions in the market and understanding the risks. So we come at the market from a lot of angles. And not a blatant plug, but yeah, sort of. We have a monthly report that keeps our clients and subscribers up to date on these dynamics. The things that I'll be showing you in the next slides will be sort of the things that we update fairly regularly, and things you should be aware of if you're doing anything in the carbon market in the next decade or beyond. I'll just share our PowerPoint. Okay. I'm going to just look at the main dynamics in the market, obviously supply, demand, and price. And Cameron did a great job of running through some of the historic transactions that we've seen in the market. It's worth noting that the carbon market is in volume, by a volume, it's largely contracted to the government. So what Cameron talked about there in terms of and some of the demand in the market is for historic carbon abatement contracts. We'll be looking at future demand. I'm going to talk about how you get involved, brokered markets and over-the-counter bilateral trades, noting that carbon is really a commodity and you can trade it as such. I'll talk about how it's traded, and we'll look at just some of the issues and questions you might want to ask when you're looking at doing some transactions in carbon. But today's focus is going to be on domestic carbon. We do a lot of work in the international carbon market, but we're constraining our view today to to just the domestic market. But I'll talk to a couple of points where the international market will influence the Australian domestic price in the future. Just wanted to point out this slide from Cam. He put up today's ACCU supply and demand. This is from the regulator's perspective. Just for clarity, the regulator has the demand in the CAC through the carbon abatement contract, which I'll refer to as a CAC, a CAC afterwards, and the supply is what they see have been held or already surrendered into the register. So this is historic supply and demand. Well, and they're looking forward, obviously, to what the carbon abatement contract to the government is. But it's a real fundamental dynamic in the market, noting that the government is the biggest buyer, has been historically, and there is a demand to meet. Supply needs to meet that contracted demand. It's a major thing to note. Sorry, as Cameron was saying, there has been quite an uptick in projects registered in the last couple of months, in particular. What we've done here is just break it down into those contracts that have got a carbon abatement contract and those that don't, just to prove my point there. The orange lines are auctions. Sorry, the yellow lines are the auction dates, and the orange is the optional carbon abatement contract. One of the things to note, which is very interesting, is some of those the projects that got a contract were from historic projects, whereas if you look at March, you can see that a material number of the projects that were registered in March actually went on to get an optional contract. But note, for those who are looking to buy in a liquidity sense, there has been a real trend towards uncontracted projects. So these projects are being registered, but they're not going on to get a contract, meaning that the volume from those projects may be liquid. I'll also note one other thing, and that is that a lot of the historic contracting does require new projects to come on board to fill that contract. So it's a little bit more complicated than it might look in the first instance. But just where can you trade and what is traded? We keep track of the trades that go on in the market, and these data are provided by two of the brokers in the industry, OMF and TFS. There are several other brokers around who do trades. We also I note from Cameron's, if you look at the volumes that these are transacted in the market by brokers and then reported as transactions. If you have a look at May, for example, you can see that was just under 40,000, about 33,000 ACCUs were traded in May. If I flick to Cam's, thank you, Cameron, for this update. The total transactions that the regulator saw within the registry was more like 175,000. So you can see that just between what the regulator's seeing transacting in its registry and what the market is seeing, that you're looking at a material amount of transactions do take place off market. And I haven't done that percentage in my head, but it's only about 25% of the transactions in that month were done on market and quoted. The price on the left, it's what Cameron has also shown. It's in a little bit more detail, which shows that it did peak just above $17 at the end of last year. Was tracking along fairly well January, February, and then I think like all markets, has suffered a little bit during the last 3 months of COVID, and the influence that has on the market. From a dynamics perspective, things you should know, buyers are generally just sitting back in this market. There's no real sense that there's a need for the price to fall, but with an absence of buyers who are sitting on their cash or not investing right now because of maybe oil prices or gas prices or global commodity prices, you have seen a weakening of the price. We have talked about that one. Talking about demand, we're looking at future demand here. So this is a graph that Market Advisory Group produce each month, an update each month, which shows the different demand sources into the future. So we don't on this graph show historic demand from the carbon abatement contracts, because we assume that that's largely, it is largely equal, and so cancels out supply and demand here. The Climate Solution Fund underpins this market. It's the medium blue down the bottom. The voluntary market is the next lighter blue, and then even lighter blue there is liquidity. And we note in all markets, we've seen this in the renewable energy market, there is a need for liquidity. Banks need to hold, people need to hold into the and as a hedge. So you have some liquidity. And speculative and trading, you do see people come in and purchase carbon units, and we think there's a material. Carbon is a commodity, it's a global commodity, and will trade as such. And so there is a speculative nature to it. The other one is what we break it down into sort of new projects from the LNG sector that will come online later in the decade. That it's unknown as to what the actual demand might be, but you do need to factor in that there will be some demand kick up later in the decade from that sector. And also we look here at a short. We do think the market is short on its carbon abatement contracts, even though there is supply out there in the market that Cameron looked at. I think I've got it there. There might be units available, but at what price do they transact? If the spot price is trading at $16 and the carbon abatement contract was done at $12.25, you can't really use that supply to meet that demand. So there is a bit of an issue that the industry might have to look at. We look at it and we analyse it. So it's there. How it's met is up to every individual project that's short, and it'll be done in a range of ways. It's not necessarily a panic. There's nothing to worry about. It's a standard market at play, and the market will solve it. It is just a demand that we'll see come into the market and require new supply. We also put on this graph one of the major dynamics. If you're asking about a dynamic in the next decade of the ACCU market, you must take into account ACCUs that will flow from existing projects that once they finish their contract with the government, they'll still be getting credits for another 15 years, 25-year vegetation project I'm talking about there. 10-year contract with the government, the years 11 to 25 are freely available for transaction in the spot or for forward contracting, and that hits the market in 25, 26, 27. So you see a lot of supply start to hit the market in those 26, 27 years, and then we see that drift off because it is vegetation and it gets less and less. And obviously it is correlated to the top line as it grows up. So that's a really interesting dynamic to keep track of. Later in the decade, there should be a lot more supply coming out of into the spot market. We just took a look at these two graphs. I'll try to flick back and forth so you get a sense of the scale. This is what the demand might look like in Australia if we decide not to use our Kyoto carryover units. So it's been discussed again, reiterated again that the government won't be using carryover units, but we believe it's an untenable position in the global carbon world to continue with that idea. And at some point in the next decade, the government will need to commit to not using them. And if, for example, 50% of the gap that would leave in the marketplace was needed to be sourced through the demand from ACCUs, that's the material increase in the demand that can come into this sector. Having seen that, what I would say about demand is most of the demand settings that we see in the market are low and can all move up very quickly. Demand doesn't really drop very much. So there's not many levers you can pull back down. Most of the demand levers push up on demand, and we'll be somewhere in that hashed area. What scheme it is, what demand source it is, we yet to that's just a hypothetical at this point, but it's there as a scale. Supply. We move on to supply. This is our assessment of the supply potential in Australia under $30. We've kept $30 there because we don't want it above that. We start to get into the crystal ball world of what could come down the pipeline. But we analysed every methodology in Australia and its potential to produce supply at different price points. And this is it's as good as you can get as a guess. I think we don't for a minute think that there's a shopping mall out there that you go and purchase these units. These are new projects that need to come online and need to be made commercial and need to be financed. But this is what we think the total volume in Australia could look like. Of course, it could be higher, but we're about 16-17 million tonnes of supply under $30. And if you just flick back, we're talking that was per annum. We're looking at demand of 20 million tonnes laid in 2028-29. The new project supply that we're showing in this graph mixed with the post-CAC supply means that you can have you can put an idea out there as to what the forward price of carbon needs to be. If that demand is accurate and the supply curve, the marginal abatement cost curve there is accurate, then this is the trend you'd see going forward in terms of price. Now, there's a lot in that I won't go into, a low range and now a high range and our certainties around that midpoint range. You can see the effect that we're modelling happens around 27, 28 when that supply comes off post-CAC. But if you're looking to make a strategic plan for your carbon abatement over the next 10 years, there's nothing like a forward price curve to help you make that decision. Just note, I'll go back there. Just note that international carbon units, which are currently cheap and plentiful, will almost certainly not be cheap and plentiful, and may not be as cheap as you think as we get close to the end of the decade. We're seeing a lot of change in the methodology types, the removal of renewable energy methods from different schemes, which are the main provider of volume. We're seeing increase demand from CORSIA, state governments, corporates, voluntary markets around the world that we think will push the international carbon price up quite materially over the next decade. Don't think you can go and buy them cheap and hold on to them because it's likely that they'll be vintaged out. So just be very careful. Don't run away from this and transact at all. Give us a call. There's a lot behind it and a lot of risk that you need to be aware of. I just wanted to quickly chat about LGCs and the convergence price that Cam was talking about. Just note that if you look at our forward price curve, then the convergence between the LGC market and the carbon market happens a lot sooner. Cam has projected ACCU spot price flat from where it is now, whereas our forecast by 2020, if we look at it's about $27 in 2025. It will start to converge in late 2021, early 2022 is our prediction. So just take that into account when looking about switching. And that's that's for me the key points. From the slides. I'll stop sharing for a sec, and just in 1 minute, just look in the eye and just say that the Australian carbon markets there is a market. It's liquid in a sense. You can buy some if you want to buy some today, but it is illiquid in a sense of real volume in the short term. And you should get advice around that carbon market strategy if your procurement strategy, because there are some real risks, counterparty risk, project risk, policy risk that you need to take into account. International interface, it's a market. It's actually quite mature. It trades optionality, it trades derivatives, it trades forward, and it's really prepared to meet demand, your needs. But you do need to get advice because there's a lot goes on behind it. And that's all. And I'll finish there. Take questions.
Thanks, Rath. Excellent. Some really good insights there. And those slide lovers today can rejoice. We've had a lot of content on graphs and charts today and plenty of questions coming through as well. I think some of the key things I'm taking away from Rath's chat is that demand's not dropping and it looks like prices are not dropping. So interesting to see there. So moving on now to our Q&A. I can see you guys have been very busy posting and liking a lot of the questions. Might start with you, Cam, first. So I'll try and bundle a couple together in the last 15 minutes we've got here. So there's a question here from Anonymous. You mentioned that the carbon units represent 10% of emission reductions. How can the existing schemes be developed and strengthened to drive this percentage up? And I might bundle that in there with what are the demand drivers for ACCUs as well?
Yeah, thanks, Anonymous. That's a pretty cool question. Look, I think going to the start of the question, how can existing schemes be strengthened? One of the important things to think about is that we've got most of the infrastructure we need to make this happen within the national schemes that we have. But I can direct you to the King Review. It makes a lot of recommendations about how carbon markets can be opened up and encourage voluntary participation more. They're being worked through, but there is in some respect, it will grow somewhat in its own right. I think if you've seen, and Brad went through it last week fantastically, the net zero commitments that people are bringing forward, those need to be met, and they will be met in part through carbon units. Look, from a clean energy regulator side, we're obviously always looking to improve the visibility of the market information through things like our quarterly reports, and make it easier to, transact with us. I think there's a question a bit later on that I might tackle as well, Gloria, because it's quite interesting about co-benefits. One of the things we've done recently in our registries is to be, particularly in the ANRU, is to be able to, when you're looking at certificates that you might hold, you can actually hover over them and kind of track through to the provenance of those units, so you can understand the kind of co-benefits. So that's a really exciting thing to support people really seeing where their units are coming from. Going to the so what's the second question, Gloria? I've got to go find that.
Oh, just around general demand drivers as well. And I might just, there's just one in here as well. I don't know, speaking of transparency that you were going on, how much of the increase in voluntary activity is due to a single buyer, or perhaps, a handful of them? I don't know if that level of...
Look, so there's some really big participants out there in the voluntary sector. Councils in particular, like Brisbane City Council has always been a big participant. But we're starting to see corporations go more and more into it. If you look at the climate active participant list, it's grown by 50% over the last year. So it is quite widespread. While there's some big corporates that are making big commitments, there's lots of smaller entities doing the same. So it's not one dominant player, I wouldn't say. Going back to drivers, and that goes a little bit to the future drivers, obviously these low carbon commitments from a lot of Australian corporations now will be a big driver going forwards for ACCU demand. There are other drivers. The desalination plants that are speckled across Australia do consume quite a lot of carbon credits and LGCs as well. So that is a driver, but it's not probably a growth driver like the net zero kind of claims. And there's obviously a driver through the Climate Solutions Fund and Emissions Reduction Fund, who RAF, as rightly pointed out, still has more to buy. And we've still got some money left in the Emissions Reduction Fund and the Climate Solutions Fund to go as well. So there's a substantial amount of demand driving, and as RAF kind of says, there's probably it's supply we need to think about in terms of meeting demand rather than demand itself, because it's quite solid and substantial. I might hand over there. Raf might want to have a say in that as well, I think.
Yeah, I might bring you into the conversation here, Raf, and I can see you've been a bit active on the Q&A and answering a question there about the oil and gas prices and what that means in terms of carbon prices as well. Just wanted to expand on that a bit more.
Yeah, Cam's got a feedback there, I think. I went through the demand factors in our demand curve, and each one of those we pull that apart and deconstruct it in much greater detail. State governments are a particularly interesting demand source with some 2050 and 2040, 2030 goals for carbon neutrality. We'd have no idea of how they're going to do that and how much of that might flow through to the ACCU market. Similarly, we don't know if the federal government would increase the Climate Solutions Fund or create a whole nother fund that might include clean technology that might be focused on facility, industrial scale emissions reduction or carbon capture and storage. There's a whole range of ways that people could come in here that might not be in the ACCU market, or they may. But the demand that we forecast in that chart there is very low. We're not trying to over exaggerate that. So there's always ways that will increase. The government is the main buyer. We should just be aware of that right now. And if the government's going to change from being the main buyer, it will need to implement, to meet our targets for Paris, it will need to implement another scheme. The question that I answered there before was just around that LNG price, the oil and gas price and its effect on the market. Interestingly, the Australian market was fairly immune from global growth, the global growth issues around COVID, and that's because the government's the main buyer. The government runs an auction, and the auction isn't really affected by global commodity prices. So it doesn't translate. If we were an economy and a growth connected carbon pricing mechanism like Europe has, then you'd see prices come off in line with growth forecasts, but that isn't the way the carbon market in Australia currently works. So it's interesting that in the short term, buyers who are from that sector will be sitting on their cash, and it's really difficult to forecast how that will play out in the long term, because if you can tell me where the oil price is going to be in a few years' time, then I'll give you an idea of what that might do with carbon. But it's really, that's the growth of the world is now a big question mark.
Great, thank you. And just related to the government being the main purchaser, we've got a question here on the option to deliver contracts, which you guys showed on your slides as well. People taking that up in the previous auction. They're asking, what is is that possibly driving the drop in contracted abatement over time? Is it related largely to that option to deliver contract?
Could I first,
Sure.
even though it's your contract?
You can both take it.
Yeah, I think. The optional, the cause and effect is not like that. The uncontracted abatement, as I would think, largely due to, if you accept that short position that I showed in the market, there's a fair bit of new projects that are coming on to fill existing contracts. A lot of liable entities are doing projects, so they're creating projects without needing to get a carbon abatement contract because they need them themselves. So it doesn't influence in that way. The optional contract, however, is certainly the cause of the uptick in project registrations. The carbon abatement, the first two things: one, the price increase, which was a great price signal to the supply side to bring projects forward. It was one, the price jumping $2, and the optional contract is a fantastic contract for soil carbon projects, for savanna burning projects, those projects where maybe sequestration is unknown in the future. An optional contract is a really good way to get certainty of price if you create the ACCUs, but not have the liability if you are short and you don't have to deliver. So I think the optional contract and the price can be seen to have spurred a lot of this new supply that's coming into the market at the moment.
Cam, did you want to chime in?
Yeah, just to add, so mid-term contracted carbon abatement in the mid-2020s is at its highest level under our current contract portfolio. You can see that in our quarterly carbon markets reports. So from now until the mid-2020s, the amount of abatement we expect to be delivered under contract will increase each year. I think in the short term, what might have been seen in the chart on the short term was just a bit of contract inter-year flexibility. So certainly the amount contracted grows into the mid-2020s. And then obviously, as I mentioned before, we still have additional auctions and additional funds to, I suppose, commit, and that will build out the second half of the 2030s, in particular, when projects are delivering in 2025 to 2030.
Great. Okay. I might change tack a little bit now and move on to renewables. There's a question here around ACCUs and LGCs. I know you've both got views on that, but I might just throw that to Cam first. Just wondering whether those two, are you suggesting whether they might be fungible in the future, and just what are you seeing in terms of that?
Yeah, so to be clear, they're not directly fungible now. Certainly for climate active participants and people who use green power, you can use LGCs to reduce, I suppose, the amount of direct emissions that are accountable to you, whereas ACCUs genuinely offset each tonne of emissions you have. But the point here is really that they're both used, and they're used for similar but not identical purposes. There is a King Review recommendation around this that I think it'd be worth looking at, about how we can communicate how they both contribute in different ways, but they're definitely not directly tradable. Some situations an LGC or an ACCU can be used for a similar purpose.
Great. Now, Ralph, I know you've previously done a MAG report with a deep dive on the LGC and ACCU interplay, so I'll just get your views on that as well.
Yeah, I think to what people think the fungibility means. It is. Let's look at a fundamental international carbon integrity rule, and that is newness. A newness and additionality. to think that fungibility means you might be able to take LGCs that have already been the projects are already started, they've already received some kind of support, financial support, that you might be able to take the LGCs that are produced from an existing project and then use them as a carbon, and then turn that project into a carbon project wouldn't meet any of those eligibility, newness and additionality requirements. So you'd be very careful about that kind of analogy. But Cameron's right. I mean, one LGCs, whilst they're a megawatt hour, they're not a carbon. You could come up with a way of calculating what the emissions reduction is from that megawatt hour of renewable energy. But then you've got a problem is, when was it done and what was the grid intensity at the time that you're offsetting? When there's so many complications. We think it would probably be much easier to create a carbon methodology, an ACCU methodology for renewable energy that has newness and additionality criteria that are equivalent to all other methodologies. That'd be easier to do and have more integrity than to go down the path of some kind of fungibility calculation. Not that we're trying to dictate policy by saying that. I just think from a market perspective, that's our view. From a market perspective, it'd be much better to have apples for apples, and the methodology, our ERAC overseen methodology scheme is considered best in the world, really, for integrity. So I think we should stick to that.
Yeah, that's a very good point there. Thanks, Raf. Whilst we're on the topic of additionality, there's one here around how to address the additionality issues from emerging tech and bioenergy. I think, Cam, you mentioned that on your last slide around the new linkages with carbon markets around the tech roadmap and bioenergy roadmap. Do you have any thoughts on that?
I think generally for anything new, it's, well, particularly, Raf kind of talked about methods there. So if the method doesn't really accommodate any new tech, then it's going to be a bit tricky to get those activities in. So that's kind of an area of focus, I think. I think with new technology, that generally passes a lot of tests unless it's kind of incentivized through other means. So government has been incentivizing various, new investments. Hydrogen, bioenergy, all of those kind of things have attracted various levels of government support. So usually our schemes are kind of not at the initial stage of the technology, but the broader rollout, and that's certainly the case with renewable energy. But I think they can work through. It's just a question of what's the new technology and how is it accommodated within the ACCU frameworks.
Point there. Raf, did you have anything to add to that one?
Only that we've tackled this before in the facilities method and industrial energy efficiency method, that the industry has tackled the additionality question, a methodology that, what Cam prescribes, that the methodology for those technologies will take into account newness and additionality. We have had a carbon market now for quite a while. Some of those technologies could have fit into other methodologies. If they haven't come forward yet, then they're probably new, right? So, that's a good thing about having a 10-year-old carbon market.
Very good, yes. Plenty more to come. So with 1 minute to go now, I just wanted to thank both yourselves, Cam and Raf, for your presentations today. Obviously, to all of you, our participants here today, and we look forward to seeing you now next week, where we actually have our first of 2 consecutive state sessions, where we're going to be focusing on market-related state-based policies and initiatives and how organisations can get involved. I know a few of you had also asked about the introductory webinar and the Carbon Markets 101. It is available on our CMI Marketplace and also the CER's Market Engagement and Resources webpage. So do check it out if you haven't seen it yet. It's a really good precursor to this entire series. So thanks again to everyone, and also to the team at CMI here behind the scenes helping put it together. Enjoy the rest of your day, and I hope to see you next week. Thanks.